Ever wonder how to keep your retirement investments on the right path without accidentally giving Uncle Sam an extra slice of your hard-earned savings? It is a common concern for many investors, especially as they manage their portfolios over the years. When you rebalance your investment portfolio, tax rules absolutely apply, primarily through capital gains and losses. This means that selling investments for a profit can create a taxable event, while selling them for a loss might offer tax benefits. The core reason these rules matter is because the tax treatment of your investments depends heavily on the type of account you hold them in and how long you have held the assets you are selling. For investments held in a taxable brokerage account, selling an asset you have owned for less than 1 year will result in a short-term capital gain, which is typically taxed at your ordinary income tax rate. If you have owned the asset for more than 1 year, it is considered a long-term capital gain, usually taxed at a lower, more favorable rate. Understanding which specific shares you are selling, known as tax lots, can also significantly impact the amount of tax you owe. Conversely, rebalancing within tax-advantaged accounts like an individual retirement account, or IRA, or a 401k, generally does not trigger immediate tax consequences because these accounts grow tax-deferred or tax-free. To navigate these tax rules effectively, consider prioritizing your rebalancing activities within your tax-advantaged accounts first, such as your IRA or Roth IRA, since sales within these accounts typically do not incur immediate taxes. For your taxable accounts, try to minimize selling assets that would result in short-term capital gains if possible. A valuable strategy here is called tax loss harvesting, where you intentionally sell investments that have lost value to offset capital gains and potentially a limited amount of ordinary income. Always calculate the potential tax impact before making significant trades in taxable accounts. An important nuance to be aware of is the wash sale rule. This rule prevents you from claiming a tax loss if you sell an investment for a loss and then buy substantially identical shares within 30 days before or after the sale. The purpose of this rule is to stop investors from creating artificial losses just for tax purposes without truly changing their investment position. Always track your cost basis, which is the original value of an asset for tax purposes, as this is crucial for calculating your gains or losses accurately. By understanding how tax rules interact with your rebalancing efforts, you empower yourself to make smarter decisions that preserve more of your investment growth for your golden years.